Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fine.
Good morning, everybody. Oh man, my voice did not sound very good this morning. I'm sure that will kind of work its way out as we go along. All right, to the charts just right away. Good morning, Octavius, Rob. I'm sorry. Oh, you know, where am I? Why am I late? I'm not really sure. I shouldn't be this late. I was totally on track to be here on time. I don't know what happened. I did have to go and with one of the kids was supposed to be driven to school, and my wife had the car out getting heated, and I had to go turn it off. But that doesn't take 5 minutes. Anyways, charts. 10-year Treasury down quite a bit overnight, but we did just have some numbers here. U.S. initial jobless claims in line with expectations, 223 versus 220. And the continuing claims up a little bit higher than expected. Perhaps why we are seeing the treasuries move back up a little bit. But we are basically back to like where we were before day one of Donald Trump. So, I don't know. Kind of interesting. If I had kept that trade, we would be like at break even, right? So that's not a bad, taking it out here. That's not a bad trade. So here's the S&P 500. Just it's been looking really great, recovering almost all of the losses from December. We are getting to, you know, a place where it's going to be a little bit harder. So oil, you know, it kind of seems like that there's been a little bit more of a downflow in oil continued, but we're about where we were yesterday there. So gold and silver taking it on the nose this morning. Ouch. Copper down as well. Japanese yen took a bit of a dive yesterday. I think that a lot of the movement that we saw in the treasuries down was a currency movement. Kind of looks like it wants to turn back up, but you never know. And then the bitcoins, well, the bitcoins are staying above 100,000, but they're kind of having a hard time getting this to go. It kind of looks to me like somebody trying to pump it, and they're fighting them or something. So that's kind of where we're at. I do expect today to be relatively quiet, to be honest with you. You know, we had the jobless claims, but we don't really have anything after that, and I'm just not sure if the market is really, you know, like, why would it be moving today? But we are getting a decent amount of uptrend on this, you know, and well, okay, actually the interesting thing here is that this seems to be driven by the Japanese yen. There is not really a change in cumulative delta coming in the yen. So we were talking about this sort of a thing yesterday. Now we have a really good example. So first of all, when we look at the spread is very, very flat at the moment. Here's the 2 and 10, and here's the 2 and 10, 30 and 10. Okay, the 30 and 10 is maybe steepening a teeny bit, but overall, I'm not seeing huge movement in the spreads. I'm also not seeing huge movement in the cumulative delta in the 10-year. There's a bit of buying that has started here in the 5-year, but we're not really seeing it in the 10-year. But we are seeing uptrend in the Japanese yen. So it seems that this movement is probably being boosted by the Japanese yen, probably related to, you know, Bank of Japan monetary policy. Can come over here and check really quick. I don't really see any headlines or anything like that over the past 40 minutes or so. Let's make sure that we got the news squawk on. Sometimes I forget to turn that on. All right. Now I want to go into something. I was doing some work yesterday, and I wasn't quite sure what I thought about it. So I just left it alone, and now I want to come back and take a look. Where is my Oh, it's right there. Okay. But I don't have the code up, do I? Oh no, I have it over here. Yeah, okay, so oh, do I have the chart? Yeah, this chart right here. Okay, so one of the ways to look at volatility is the average true range. So one of the indicators that I have in my paid suite, not a super complicated indicator, but it's just an ATR that allows you to change the units. I actually added a new unit, so this isn't available in the indicator yet, but it will be soon. So that you can look at it in terms of dollars. So basically, this is showing me if you take the average true range and you times that by the tick value, then you're going to get the dollar value of the average true range. And it is about $4,000 right now in the S&P 500. $4,000. So that means that if you were to, on average, if you were to catch the low of the day and sell it at the high of the day, you would make on average $4,000 a day. Okay. So that is basically the maximum amount of profit available to you day trading. If you've made more than $4,000, then you've made more than just the volatility. Make sense? Okay, Illegal Immigrant asks, I've heard you mention cumulative delta. Any conclusive data on its usefulness? I am not a believer in it. Yes, there is. Although, if you go and you look for the research, they're not necessarily going to call it cumulative delta. So you might find research out there about indicators like the probability of informed trading. And what those are actually about are trying to say, okay, if there's somebody out there and they know something, right? What is the probability with the data that we have right now that there is somebody out there that knows something and is actively trading into the market, right? The reason that they create these indicators is because a lot of the time when they're doing the research, they don't have the data that they need, right? Because the best indication of whether there is informed trading in the market is the actual sign of the market orders. And it's just that most of the time when they're doing research, they don't have access to that. But we have access to that. And the way that we actually sign the orders, that is to say, when an order comes in, I know it seems like such a simple thing to us because we're in futures, but it can actually become a very complicated algorithm. And if on my indicator suite, I have advanced cumulative delta, that is a cumulative delta that works for stocks. And it's a much more sophisticated indicator that is accurate, because when you have a spread, there's problems, right? Like if an order comes in the treasuries, right? I know if it was at 13, it's a market buy, because I know what the bid and offer is, and the bid and offer are like always one tick apart, right? The only place where it gets fuzzy is if it's ticking up and down really, really quickly, right? Then how synced your level 2 and your matches order feeds are, kind of determines certain orders might be marked as buy and certain orders might be marked as sell. But generally speaking, that's only going to be like a difference of 10%. So it doesn't really make a difference for what we're doing. Okay. But in a stock, there's like a huge spread. So, and most of the volume happens in between that spread. So you don't know, somebody puts a limit order in the middle there, and then a robot comes and picks them off. how do you know that that's what actually happened versus it was actually somebody put an offer there, right? Like you just saw volume at that price. It's in between. So one way is looking at whether it's, what's the midpoint of that spread and whether it's above or below that midpoint. Pretty effective. But to really be certain, you can go and anytime that there is a fill, you can go and search for the corresponding changes in level 2 to determine whether it's a buy or sell. Okay. But that's more advanced. The basic algorithm is it above or below the current offer? Is it above the current offer? Is it below the current bid? Or if it's in between, is it above or below the midpoint? And this algorithm is called Lee-Reddy. Lee-Reddy algorithm. So if you go and you start searching for the Lee-Reddy algorithm and you search for papers that have used the Lee-Reddy algorithm to determine the sign of orders, you will find that there are a lot of studies. Okay. And I will just summarize what we get from it. Okay. It is a pretty strong autocorrelative effect on the sign of orders. So if I pick any random order and let's say it's a buy, and then I wait an hour from now, and an hour from now I pick another random order, there is a 0.5% chance that order will also be a buy. That seems like 0.5 is like super, super small, right? But like over the course of an hour and all of these other things, and you're picking a random order to begin with, like that's actually a very strong effect. Okay. So the general idea is if the market orders are buying now, there's a good chance that they will still be buying an hour from now. So why is this? Well, they did a lot of looking at it, how can we duplicate this? Basically what you want to do, all models are wrong, but some models are useful. And what we want to do is we want to make a model that displays the same behavior. How do you get all of these different stylized behaviors? One of them being autocorrelation and order flow signs, right? And I think that most people's natural intuition and, the thing that technical analysis and all these other things kind of say is that, oh, well, you see other people buying, so you decide to buy too, right? So they tried using models that are kind of like physics models that you use to model fission, right? Because it's like one thing explodes and then the molecule goes off and hits another thing, and then that one explodes, and then there's a critical threshold at which they're close enough together and everything that you get fission, right? But when they modeled the market that way, they did not get really any of the stylized behaviors that markets display. So researchers basically concluded that's not why it happens. And then they got the idea that, well, maybe it's just because there are people that are really, really big and are buying a ton of something, right? If I need to buy like 100,000 treasury contracts, that's going to move the market. So I'm going to split that out over the entire day. And when they started to model that, then we get the stylized behaviors that we saw. Okay. So the key thing. So now that we understand why it happens, now you can understand how you use it. Because a lot of people, they're doing things like, okay, I saw the stock move up, cumulative delta didn't move up. That means there's a divergence between them, and I should take a trade on that divergence coming back into play, or, coming back together or something. That does not work. But here's the way that you should use cumulative delta, is that what we're looking for is that strong autocorrelation, right? So what I want to see is, like we're kind of seeing in the 5-year, I want to see a strong and well, not a strong, but a consistent trend in cumulative delta, that every bar it's moving up or down by a similar amount, right? The more of a straight line it is, the better, right? And that is a sign that there is a large meta order at play in the market. And the longer the trend and the more consistent the trend is, the greater the chances are that there is a large meta order at work in the market. And you can kind of game out based on the other context that you have about the day. Why might somebody be executing a large meta order like that? To guess how large that meta order is, and thus how big of a change in cumulative delta you can get. And you can then therefore take the trade, knowing that there will still be more orders behind that, and hold it until it reaches the anticipated change in cumulative delta. That's the way that you use it. That's the way that you use it. So if it's using only market orders, that is missing a lot of order flow. But the market orders is like the most it's the one that has the most information, right? It's the most information. And you do have to use information from the limit orders in order to make a determination about whether it's a buy or sell, right? And it is data beyond just the price, the history that most people are using. So it's a very, very, I wish I could say that it's like, the silver bullet, but these are all like, you got to take as much information as you can and put it together, right? So I've kind of talked about, okay, you're using the cumulative delta, but you're also using what you know about the markets, reasons why somebody might be executing a large order like that, right? There's a ton of information in there, right? But that's basically, and this is also kind of like okay, I just gave you the research. That is my take on how we can potentially take advantage of it based on the research, right? There's always that's where the leap of faith comes in, right? I wish I could say that I had empirical evidence that, like, if you trade cumulative delta based on these certain characteristics and everything, it tends to be a buy. But you're probably never going to find something like that. Because there's too much noise. There's too much noise in the market. You have to have a way to filter it down to, like, when that's actually happening, right? If you knew a block trading desk and you knew every time that they were executing what they were going to buy and everything, and you just bought in front of them, you would make money easy. And there are actually quant firms whose whole thing is to try and sniff out block trading firms and front run them, and they do pretty good. Okay, and so essentially, my style of trading is mostly trying to front run block trading firms. Yeah. From your perspective, is quantitative trading superior to non-quantitative trading? So I think that all trading involves data. It's just the way in which we are processing that information, right? So discretionary trading, you as a human are reading the internet, looking at charts, looking at reports, ingesting all of this information, incorporating it into a neural network in the front of your mind that you can then use to make intuitive decisions about what you think that the market is going to do. Now, that's a really, really complicated thing, because your mind is a very, very complicated thing. But in the end, it is still your mind ingesting data, doing some sort of analysis and processing on it, and using that to determine the trades that you're going to take, what orders you're going to place when, right? We can program to some degree now some of the ways that the mind works, because we can program neural networks. That's what large language models do. So some of those things you can program. I think, in fact, really the challenge is really more the data. It's like you're reading all of these reports, you're scraping all of this information from all of these different sources and everything. How do you do that and get that into your robot? But it's totally possible. So in my mind, quantitative trading is really just trading, but automated. And that's all there is to it. Okay. But, you know, that's where it comes back to, like, there's always kind of a leap of faith of some sort, right? So really kind of the question is, where is that leap going to be? And what the leap that most people make is they just create some fundamental belief about what the market is. And, you know, they just trust that. And then once you have this idea about what the market is and how it works, then you place trades based off of it. And when, you know, most people, they tend to fail, right? We have some really good empirical research that tells us, you know, like, what is the actual nature of markets. It's very different from the picture that technical analysis and retail traders paint. It's also a very different picture than the political culture in the Western world paints. Because the political culture in the Western world is basically markets are perfect and infallible, and they're always, prices always reflect all available information. And yeah, right, it's nonsense. It's nonsense. And once we realize that, like, the market is not very informationally efficient at all, and in fact, the reason trading is so hard is because it's so inefficient. It would actually be easier to trade if the market was a little bit more informationally efficient, right? Okay, and then we can deal with the consequences of that, right? Look at the way that the market actually is, then we can kind of, you know, based on that data, try and come up with trades and see if they work. And hopefully there are situations where we can, like, actually empirically test those trades, but as retail traders, we don't always have the data, right? Okay, so the Dixie weightage doesn't make sense. Is there any good alternative for that? So I'm going to say yes and no. So I have seen there are other dollar weightings, and I don't remember their names. I think that there's like a Bloomberg one. I think that Bloomberg has one. But by and large, still, the industry still uses the Dixie. So, and I think, honestly, though, Raul, that the whole thing about the weightage, it kind of is going to be relevant in that. So why do they say that the weightage is wrong? The Dixie was kind of based on what was the amount of trade or currency trade with between those different currencies with the dollar, right? And that's how they kind of came up with the weightings. So that was like 100 years ago. Certain countries contribute more or less to that now, right? But that's only going to matter, I think, if you're trying to use the Dixie to predict, like, what the balance of trade is going to be and things like that, right? So it's going to matter if you're doing certain economic models, right? But for our purposes, which is to help us differentiate between when the market is moving because of a move that is specific to our instrument versus when the market is moving because of correlations with different currencies, the dollar index does a good enough job. If there are other weightings that you find that you would like us to put in, I could certainly make them. Yeah. Did I miss anything here? No. Yeah, okay. So there you go. All right. So, coming back to, what was I looking at yesterday? So here's the average true range. We've represented the average true range in dollar terms. So basically, you take the average true range of a daily bar, and then what is the actual, like, tick value of that? And it comes out to about $4,000. Kind of interesting. You think about it, like the combines, they want like a $2,000, $3,000 profit or whatever, right? Well, like, that's less than the dollar value of the average true range of a single day. And yes, so that's how leveraged you're trading. Okay. But so then there's this idea that we can basically take the ratio of, like, what is our profit target, or like what is the actual size of our account, right? And what is the ratio of that to the average to range. And that would kind of give us some idea of like how leveraged we really are, right? So that was kind of my thinking. So then I kind of thought, well, okay, what if we take a random strategy? We make a random strategy. It will only hold it for 30 minutes. And then, like, what is the drawdown on that, right? But to basically try and game out, like, if I'm trading one contract, how big of an account should I actually shoot for, right? Like, what is the optimal best size to start with? Or what is the minimum size that you would start with, right? Okay. So I went and I programmed that up. Oh, well, let me show you the code. So if you haven't seen this code before, basically on the first bar of the session, I get the trading day, and then I get a random integer. And I use that random integer to basically select a random time within the most active period of the market. So we want to do it like between basically when we're streaming. Okay. So it basically uses a random number generator to pick a random time to take a trade. And it also takes a random, it picks a random direction. Okay. And it uses a random number generator that takes a seed so that you can pass it the same seed and get the same results if you want to go back and like retest something. Okay. So here it is. Here, when it gets to that time, it takes a trade. And then I also added in here, when it takes a trade, it keeps track of what bar it entered in on. And it waits until it's been in that position for 30 bars or whatever you set and exits. Okay. So we have a trade that trades at a random time and holds every trade for 30 minutes. Okay. And here are the results of that strategy. Okay. So like, right. Some of them are going to be profitable and some of them are not. Some of them are going to be really profitable and some of them are not. But what I really wanted to see was like, what is the maximum drawdown? So here's a scatter plot of the maximum drawdown. But when I look at this, I can see here that there's like, okay, there's some outliers at 5,000. But then when I look up here, I can see, oh, no, there's like this one up here at the top, that's 13,000, 10,000, 10,000. Like a lot of these went way further than that, right? So I don't know why this plot is not showing me everything. Maybe it's just that like it can only show like 100 samples, or because I don't think that there's 1,000 thoughts on there. Maybe. I don't know. So, okay, let's go and model it in R. So I went and I did it in R. I don't know if you can see that actually. It's probably like really hard to see that line. But if you can see here, it actually, this is the density. So it actually looks like that there is a peak in the drawdown around 15,000-ish. So it's basically saying if you traded randomly one trade every day for 5 years, that you should expect to have at least 15,000 drawdown against you, is what I think that that's saying. And then, you know, just kind of scales down to 70,000, right? So what does that tell us about what size of an account you should maybe use? Does that mean that you would want if you're going to trade the S&P 500, that you should probably have at least 20,000 in an account to start? I mean, maybe if that's like was your only chance, maybe. I don't know what to think about that. But going back to the ATR, is it related to the ATR? It seems like no. So I'm wondering, maybe I think there's some flaws in maybe the way that I'm trying to look at this, right? Maybe trying to base your account size based on the dollar value of the average true range doesn't really matter. Doesn't really make sense. Maybe my random trade and looking at the maximum drawdown of the random trade, maybe there's some flaws in analyzing that way. I don't know. But that was the experiment that I did yesterday, and I thought it was really interesting. So I thought, I'll just come back to it tomorrow and look at it at the beginning of the stream and see what I think about it. And I'm kind of thinking that, like, I don't know if this drawdown, like, should that really be the, like, my justification for how big your account should be? I mean, I guess if you look at it like that way and it's 15,000 but you trade a micro, that's 1,500 or 2,000. So is the minimum amount that I would recommend trading the ES mini contracts or micro contracts on is $2,000 account? Well, that does sound reasonable. That does sound like about in the ballpark of what we would like. So maybe. But I do find it curious that, like, it's that many more times than the ATR. So it's basically like 4 times the ATR, 5 times the ATR. So I don't know what to think about that. Okay. Just taking another peek at the market here. It kind of looks like the downtrend. While I was giving that whole spiel, because that took a long time. I think I can close this now. And I think I can close this. 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 It kind of looks to me like my market imbalance strategy should be trying to take a trade right now. Looks like we're in the second leg of the meta order. Yeah, I don't know. Really seems like that it's just been all sell since then, and that we are in a meta order sell for sure. Okay, Rawl says, when treasury trends in a good manner, it's either show up on the Dixie yen Swiss franc. What's the whole logic behind that? No, there's a risk on, risk off thing. Well, okay, so more generally speaking, the largest purchaser of treasury bonds is Japan, essentially, between the Bank of Japan and all of the mutual funds over there and all this stuff. Because basically interest rates are so low in Japan that you basically just cannot make money from holding bonds in Japan. So they all come over here and buy US bonds and get the better yield over here. And like, yeah, you still kind of lose money over here a lot of the time, but it's better than the alternative. So that's why treasuries are strongly positively correlated with 6J. Okay. So if the value of the yen overall is going up, then you tend to see the value of the treasuries go up, because that basically means that they can buy more treasuries, right? But it's not always just about the Japanese yen. There could be a move in the euro. There could be a move in the pound that could be affecting things too, right? So that's why I will tend to look at the 10-year treasury, the Japanese yen, and the dollar in that order. So like if I see a move over here, doesn't really seem to be accompanied by any significant change in cumulative delta. Okay, am I seeing it in the Japanese yen? Well, today I would say yes. Yes, you are. And so maybe it's the Japanese yen that was driving it. Then I'm going to say, okay, why was the Japanese yen moving? Can I find a breaking news story, or perhaps something else that I know about the market, certain, strategies, rebalancings, all of these sorts of things? Maybe there's a Bank of Japan meeting coming up that people are hedging for, like, like what could be the reason for that flow, right? I would always prefer, you don't have to know. You're not going to be able to know every time. But if you can know, it's better, because that gives you a much better idea of what's going to happen in the future. You remember yesterday when we were talking about, okay, if you have a graph of a car's velocity, can you predict what the velocity of the car is going to be 30 minutes from now? And in the scenario that I gave, where the person gets home and the car stops driving, then the past history isn't really going to tell you what's going to happen at all. So what's the piece of information that you need to know? Where they're going to, right? And it's kind of a similar sort of a thing, right? Why is the Japanese yen moving? That's the destination. So it's the thing that's driving it. It's the thing that's actually like independent, right? Like when you're doing an XY, you want to have an independent variable and a dependent variable. So we have time and price, for instance. What was the price at this time? And that's the connection between the two, right? It's incorrect to do something like change the x-axis to be every time that price changes by 5 ticks, because now your x and y axes are related to each other. They're not independent and identically distributed, right? So you want the piece of data that's like independent. What is actually like causing this thing? Why are the orders being submitted? If I can determine that, I can make much better decisions about what's going to happen next. And looking at the currencies is a very, very effective way to kind of narrow down, right? Because now I can go and I can say, okay, because I know that it was in yen, that kind of narrows things down to what are the things that could be potentially be that would move the yen like that. And I can, other theories that I might have had about why it was moving, I can cross out, right? Or if I see it's not in the Japanese yen, I see it's in the dollar. Oh, okay, actually it's in the euro. Was there something going on in the euro? The logic and connection between the Swiss franc and the treasuries. So the Swiss franc tends to be a safe haven. So like if the treasuries are going up, you will often see the Swiss franc go up, because if there's like a flight to safety, right, then they're going to be really strongly positively correlated. But to be honest with you, I do not watch the Swiss franc that much. In fact, I don't think I even have one up anymore. I can only recall like 1 or 2 situations where the Swiss franc was the difference. So, but it has happened. It has happened. Well, I must say, they have kind of paused here, but despite that pretty good trend down, I still don't have a whole lot of confidence in it doing a whole lot. It still seems pretty slow and wishy-washy to me. So, yeah, I don't know. Oh, you know, so I was thinking yesterday about robots. So, like, we have AI and we have large language models now, and you have all of these CEOs and people in the industry are like, yep, we're going to replace all coders. We're not going to have these anymore. I'm really skeptical about that. I think that, you know, of these CEOs, because they are kind of like developing AIs and things like that, they kind of have an incentive to try and tell everybody that, like, it's going to be all AI, right? But at the same time, then I think about it and it's like, but you know what? Like, I was replaced by a robot. Like, my dream was replaced by robots, right? I wanted to be a market maker, and now robots do all of that. So then I was like, oh, okay, so can we look at the automation of market making and gain any insights as to how things might similarly go when we automate other industries that were previously difficult to automate, in particular coding, right? Well, what happened? What happened when we automated things? Well, first of all, there aren't any human jobs really doing market making anymore. Pretty much almost all went to computers. And you as a human can try to do market making, but it's super, super hard, right? Super hard to compete. At the same time, the number of jobs in the trading industry has gone up. The amount of activity in the market has gone up. There's also like a lot more noise out there, right? The signal to noise ratio has declined. So when I try and like carry that over into like, how might that affect coding? I'm kind of like, well, you know, I think that, first of all, can they actually replace coding? Well, I think that there's a lot of code that, you know, is not unique, right? Like, so you're writing code, somebody else in some other organization somewhere has written similar code, right? So why do you have to write your code? Well, because there's all of these little nuances related to your specific business and your specific company and everything that you kind of have to account for, right? So there's your first problem. There's like, LLMs are not good at that. They don't know about your company. They don't know all of these little things, right? And I find that a lot of the time the writing code bit of things is kind of like really just straightforward, and like the real job that you're doing is actually teasing out and understanding the requirements in the first place, right? Something that the LLM cannot do, I don't think. So there's that, but then there's also this thing that's like, okay, but if you have an LLM that's basically able to write all of that kind of code for like simple business cases, then that just means that, like, in order to have like really good tech and stay ahead of the curve, you're just gonna have like more sophisticated software after that, right? Is basically like, now you can go to some of the more complicated issues that like you never get to because they're too hard and whatnot. So on one hand, like there might be a bunch of low-level programming jobs that go away. But then at the same time, probably the really in the weeds, really complicated programming sort of thing, there's probably a stronger demand for those afterwards, and those jobs are worth more in the long run. I kind of wonder. Octavius isn't going to sell the pullback to the VWAP. I know, it kind of looked like they were going to like balance around 10, but they just kept going. They didn't really slow down at all, did they? Back to the car velocity analogy, couldn't one also use a location other than the home? It's like, say, going up a steep hill. Yeah, I think he could. Yeah, I think you could say, like, okay, the car is going 35 miles an hour right now, but now they're on an on-ramp, so I should expect that in the near future that they might be going 65 miles an hour because they'll be on the freeway. Yeah. And there might be some narrow situations where, based on the current location, direction, and velocity, you can predict the velocity in the very near future, right? And that is kind of like a lot of what we do with looking at the liquidity and the market orders, right? So I can see, like, there is a meta order going on right now. It's probably yay big, but they're heading into a location where I anticipate that there's going to be more liquidity than usual. So will they be able to get through it based on the number of orders that I expect? Actually, no. Ergo, maybe I don't want to take a trade, right? Yeah, you can do that sort of analysis. Although it's really hard to know where there's going to be liquidity outside of, like, how has it traded in the last 45 minutes. So there was some, we haven't traded 08 in a while, so you might expect that there would be more liquidity down here. But it's been more than 45 minutes, so I don't think that 08 should have any more liquidity than any of these prices. I'm not seeing any kind of aberrations in terms of amount of liquidity resting. I also do not see any kind of, like, really key levels either. Which is to say, like, round numbers. I don't really see round numbers. If I get to the volume profile, there is, I guess, seeming support here on a larger term chart at 08, essentially. So if we breach 08, we might see short-term momentum players come in. That's something we might want to keep an eye on. But at the moment, based on the way that it's come up to that and how it's behaving, I don't know if you're gonna, I don't know. Like, I do kind of think that we should continue to see a meta order. It's just like, it's a really, really gentle one so far. Speaking of velocity, would that make the rate of change? Not necessarily. That was the velocity part of it was just kind of an analogy. I've kind of done some stuff with rate of change, but the results of that work were very inconclusive. It seemed like that there's, like, it's very different from, like, what I would normally see if I was, like, back testing something and it was just random, but it didn't really come out as like, oh, this is a really great strategy. But I didn't look at it on a daily basis, so I need to go back and look at it on a daily basis. Before the start of each trading year, what's your trading goal? Oh, like, I really don't think about that sort of stuff that much, Raul, to be honest with you. I think that if you were to perform better than the S&P 500 on a yearly basis, that's, like, really good. It's, like, really amazing, right? of course, depending on like what your the Sharpe ratio you have to use to get that and everything. But but I really the only thing that I really think about is that I would prefer to make enough to pay for like the data fees is the main thing that I think about. So like one of the things, so I'm making a video about how big does your account need to be, and I think one of the things that people would probably do better with, because they say like only risk 1 to 2% or something like that, right? Really, what you should be thinking about is like, okay, I'm gonna start a $2,000 account. How long will I be able to trade with a $2,000 account? Like, let's just assume that I don't make money, because if you're a beginning trader, it's almost guaranteed that you're going to blow that account. So pretty much every person draws down the entire account for their first account. That's just the way that it is, right? So how long does it take you to do that? Well, unfortunately, a lot of people start to take stupid risks, overtrade, etc., and they can blow through that in a matter of days, actually. Okay. But if you're really being cautious with it and all of those sorts of things, like $2,000, that might last you a few months. And then you'd go back and you'd look at it and be like, okay, so you got 6 months out of it, and now you've drawn down the account. Have you been within that time? Have you been able to save another $2,000? Right. So to me, the thing that I care about the most is my burn rate, and I want to be making enough to pay for the commissions so that I don't have to put more money into the account because the account is drawn down from the data fees and stuff, right? Fortunately, I haven't been trading for the past few months, so that doesn't help, but But I think implicit in that is also that, like, most people, the reason why they do that exercise is they're like, well, I want to trade for a living. So, like, how much can I realistically make in a year? And can that replace my income? Right? Just don't even, that analysis, it's useless. Just don't even bother thinking about it that way. Think about it as, I mean, like, take it seriously, like it's a business, but don't do it with the idea that it's gonna replace your income, because for it to replace your income, you probably need a much larger account than you actually have. Hey, Paul says, unfortunately, I also haven't been doing any trading well. Yeah. I mean, it kind of sucks because my trading has been pretty good lately. I did not expect this downtrend, man. But we did say if they're able to get below 08, we could see some momentum come through. So I think that that's what that was about. Well, I would prefer to have taken it as it was going, you know? I'll just leave it there. See if it comes back. Actually, we can do it like this. The Bank of Japan is tomorrow? Okay. Dude, reading anything on Reddit these days is like almost pointless. Like, it just can't. Yeah. This I hear on Reddit, somebody posting a site reliability engineer role. It is a junior role, but they're asking for 61 to 80,000. Like, I don't think you're gonna get, even with as bad as the economy is, I don't think that you're gonna get very many people to bite for that, because that's like what people make coming out of school. And that's remote. Huh. Okay, so they did get me to 80, huh? Okay. Maybe I shouldn't have been as concerned. Let's see. Maybe it just bounces now and it just completely flattens me. Seeing a run in Bitcoin coming through here. Oh, 09, that's much further than I thought. You know what? I just don't like the way that this went. I'm just gonna bail. I don't have enough conviction on where it should be going and why it's going to take heat like that, where it just blows right through me on the entry. No thanks. Let's let it play for a little bit. And I'm just gonna, I was tempted to comment on a post here, but like, I'm just not, I should not post on Reddit as much. Just I'll like read things and it's like I want to, but most of the time it's not any value. Like nobody reads it, or it's just stupid people. So like, oh yeah, the other big thing that's going on Reddit right now is like we have to ban X from every subreddit. Ugh. Not that anybody really links to X posts very much anyways. Wow. Lex Friedman confirms he is traveling to Russia to interview Putin. Wow. Have you heard of Gorilla? No, I've not. What is it? Gorilla AI is a runtime LLM for generated actions like code, API calls, and more. It's just another agent-based sort of thing, right? Yeah. So you know what I think is funny here? Okay, like when ChatGPT came out, the one of the first things that I remember seeing was people taking open source LLM algorithms that came out at that time and telling them, you know, okay, make this code and then run this code, etc., etc., etc. The early one that I remember doing was like, you know, they gave it some project to do, and like immediately the LLM is like, oh, I'm on Unix, I should update this package, and then, you know, like it almost immediately bricked the computer. Like, didn't get very far. So now the big thing that we're hearing is like, oh, there will be agents. You can just give it a task and then let it go and it will just do its thing, right? So that has been a thing for a while. It's just that now they have a service and it's doing it on a bigger, more sophisticated model. But what we found when we were doing these kind of agent tasks sort of thing was that like little errors would pile up. That any piece of code that the LLM would generate, that there would be something wrong with it, that it basically it had to be perfect. And if it wasn't perfect, then each step along the way, the problems would compound on top of each other. So that's like a deeper issue. Like you don't just fix that issue with like, oh, well, we just get more powerful LLMs and everything, right? Because there's still going to be a degree of reliability, right? And it's something that tends to scale exponentially as it goes up, right? So how do you get the LLM to deal with the errors in the stuff that it already wrote, to sort out that, oh, there's a problem with it. Oh, that problem was this piece of code that I wrote earlier. I need to go back and fix this, yada, 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 right? Like, so like, the big thing that I would challenge people on with these things is like, okay, so you think that these LLMs are going to replace coders? Why haven't you done it yet? Like, agents exist today. Why have you not created an agent to go and make whatever app or service or that you think, or maybe you just tell it to come up with its own idea, you know? Like, what? I haven't seen that yet. I guess the closest example of that I saw was when they gave an LLM, like the LLM created its own meme coin, and so everybody started giving the LLM the meme coin. But that's, you know, that wasn't that it made something of value, right? Let's see here. Richard Dennis managed to make 120%. No, I've never heard of that. Really? But there's certainly that if, you know, most edges will, like alpha decay is a thing. Most edges will disappear if there's too many people trying to trade it. Because it will move the market. I've heard some people say that, like, it kind of depends on the type of edge that it is, whether there will be alpha decay in it. But like some of them are saying, well, there's not alpha decay in momentum, but I see significant evidence that there is alpha decay in momentum, and that's why the performance of momentum has become cyclical compared to what it was in the 70s and 80s. Yeah, no, it can be both though, right? Like one of the issues that we get with these things is that, like, to prove something scientifically, what we would really need to do is have like 1,000 different edges and then trade them for a certain amount of time and then reveal those edges to the public and see the effectiveness of those edges decline as it's traded, right? You know? So, to prove this as a thing is a little bit more difficult, but it is pretty much in line with everything that we know about the market, and we have a lot of anecdotal evidence that it happens, and so I'd say that we have sufficient evidence at this point to suggest that sharing an edge will destroy it. Can you build a calculator for highlight a, well, okay, so you highlight a few rotations and then auto calculate what? Yeah, for yeah, auto calculate what? Well, I think you're being, well, maybe you have given me enough. So I think what you're saying is, like, I have a chart and I want to be able to go in here and I'll make a drawing tool that is like a highlight. Do we have a highlight one? Region highlight Y. Oh, region highlight X. So I come in here and I say from here to here, I highlight it, and then it will show me a number, and this number will be some sort of metric about the market within this range, right? Absolutely can be done. He says yes. Yeah, absolutely can be done. You know, like, you can make like a cumulative delta sort of a thing like that. I don't really, you know, maybe those are things that I should make for my indicator suite, but it hasn't really ever come up. But yeah, I've done it before. When you said calculator, I thought that it was like you're going to have a thing and there's going to be buttons and I can type in and do calculations. I was like, well, I can do that too. I don't know why you would want to do that though. But that's the way that it would work, is in order to do it, you would have to come in and go drawing tools, and there will just be a new drawing tool that will show up down here at the bottom. Except as you highlight, say I want to highlight just say 3 tick levels over X rotations. So not the entire bar. So, but how would you represent which parts you want to pick? So the drawing tool allows you to select a region, right? I can say I'm only going to do my calculation within this bit. Or what is often more useful to people is like, I want to know cumulative delta from here. So like this is the starting point, and then it's going to show me forever after that from that starting point, right? Or I can do it the other way, right? I only want to know the statistics of what happened in this range of prices. Yeah, can do that too. Or both. There is a rectangle somewhere, right? Rectangle. Okay, I only want it in this area. Right? Say you took 2 rotations. So like what? You want to say these 2 rotations, and it will calculate the midpoint of that whole bit. To that. Sure, you could do that. Now, where it gets a little bit more iffy, and it's not that it couldn't be done, it's just like the interface for it maybe becomes difficult, right? It's like I could potentially say, okay, I have a rectangle here, and I have a rectangle here, and the value that I get is actually combined from both rectangles or something like that. Could also do that. There's a little bit of trickery that is probably involved, like using reflection and so forth to make that happen, though. I would think that the exact calculation that you're trying to make would matter. Sent me a picture, but all I see is just the single bar being highlighted. Why would you want to do that though? Like what? So I tell you what, man. Some of the things that the ideas that you have are like so left field to me. Let's commit to that. Yes. It's 3 bars. So he has something like this, where he's got a rectangle, and he's like, okay, here's these 3 bars, right? But why? I'll really zoom in here, right? Why is it that you don't want to include the whole range of the whole 3 bars. You don't even have the whole range of this bar in the middle. So why are you excluding this bar, part of this bar? Basically, what are you using to determine your top and bottom of the rectangle? Like if we're saying that the X is determined because it's 3 bars, why are you picking those values for the Y? Just to make it flexible? But all you want is the midpoint? You just want to know what is the middle of this rectangle? Especially if all you want to know is the price midpoint, that's easy. But now well, I don't know if you can make that necessarily flexible. Like, so you have this thing where it's like, I have this tool and then I can like make my own calculation that it's going to make in the middle or something. Like, I don't think you can really do that. Especially not something that like you can pay me for and I can give to you like that. Where it's compiled and everything. Would basically you'd have one drawing tool, and that one drawing tool would be able to make that one specific calculation that you want. And in order to make it more flexible than that, you would maybe like I could make it so that like in the properties there's options, different things that you want to calculate or whatever, right? But that's only if you're doing price and volume. Okay. If you want to be able to draw that rectangle and it tell you something like, let's say, cumulative delta. I want to go back on the historical bars and find the cumulative delta of this portion. That's very hard. It's very hard. I can do it because I can do anything. And I have an idea of how to do it. But I think it would be difficult. Because basically, you would have to have the indicator running on the chart, saving the price, saving the data series information in there, and then the drawing tool would have to be able to find the indicator and narrow down the specific section of data that it wants, and right. So I think I can make that work, but it's a lot. That's an advanced indicator. That would require some tricks. Like that's like the difference between something that's like I don't know, like I think you're talking about something that's probably over $1,000 to make. If you could start over your whole trading career, if I could start over my whole trading career, I would restart university, and instead of just going into computer science, sticking around and getting like statistics or, you know, some sort of quantitative trading thing and trying to get into Jane Street or Renaissance Technology and being a quant trader and doing it that way. That's the way that I would do it. Or I would try to be, you know, like work on an over-the-counter desk at a bank, or I would try to work as a commodities trader at Cargill, right? Like if I was going to start over, like the biggest thing that I would change is changing my university career to gear it all towards working, getting hired professionally, right? Like ultimately the biggest problem that we have is that we are retail traders. And beyond that, I don't know. I think that there were points. I really just want to take more risk. I think earlier on there was some points where I could have taken more risk and it didn't. And now I've kind of gotten into a place where with the kids and everything that I haven't been able to take risk. But, you know, maybe it's not such a regret because, hey, there's a lot of life left in us, right? We're not anywhere close to done. Now, if you want to know like the mistakes to avoid sort of a thing, I have like a couple of videos about that. And I think I'm actually making a new one. But, you know, like the first one is I really regret spending as much time as I did trying to pass the combines like the way that I did. It took me a while to realize that it was basically all set up in a way to make me, just to make you fail. It's a carnival game. I think it's so funny. You know, I was reading back on the comments about from the video about the trading combines the other day. There's like people were like, yeah, but I made this much money from it. And I'm like, did you know that at a carnival that they will make the games easier at the beginning of the day so that there's a bunch of people walking around the park with a huge stuffed animal so that everybody will go, oh, I want to win that, and go and try and play the game too. And then they make the game harder and you know, to make the money later in the day. Yeah, that's what they do. The more I think about this rectangle thing, the more I'm like, oh man, there's so many complexities I could add into this. I don't know if it would really be worth it, do you? Good morning, Seth. Do you trade futures on currencies? It's not something that I've tried myself. I do watch the currencies, but you know, like currencies is a very different game. Currencies is a very different game, and it's not one that I don't know. Like, there's the whole Forex world, right? And everything that I've seen from the Forex world is like you don't want to trade it. But like, let's say that you were on a currency desk at a bank. How do they do it? I don't know anything about that. Other than like being informed, I guess. But it does seem like there is maybe some degree of like patterns that they utilize as well. Who knows? I have to read about that. You know, I think I got like the next book I want to read. So, and that one's more about commodities. So I think we're going to do that, and then we'll see where I go from there. I don't see myself spending more time on currencies anytime soon. AI is making us worse programmers. Here's how to fight back. Oh, are they more complicated than treasuries? I wouldn't say that the currencies are necessarily more complicated than treasuries. I think the issue with currencies is that there is a lot more information that you're not going to have access to. That's kind of the problem. There's all these government insiders that know what's going on and they can trade the currencies, and you don't really stand a chance against them. That's kind of the problem with the currencies. Treasury is really consolidated at now 09 there. Bitcoin has slowed down on its run. So it's kind of weird on that one move. I was kind of like, okay, so maybe momentum will come in here. But one of the things that you got to be careful about is they just go into the lion and then the meta order is done and it just kind of floats back. And I didn't like the way that it moved against me when I took that, because it kind of made me think that maybe that's what was happening, and it looks like that happened. So I wish that I hadn't taken the trade to begin with, but I got out of it pretty early, so that's okay. That's pretty good. Have you read The Market Wizards? Well, okay, so the thing that you got to understand about the Market Wizards book is that almost all of the traders that they're interviewing are momentum portfolios. Right? Like, the whole issue is like, okay, there's a lot of edge in I own a portfolio of assets and like which assets and how much of them am I going to own. And there's a lot of stuff that you can do with that, right? There's a lot of stuff that you can do with holding them over a really, really long time. So when you do catch winners, like they're absolutely huge. But what we do, which is we're coming in and you're just taking an outright position for maybe 30 minutes. Basically, you get to pick where you get in and where you get out, and there's not as much room to work around, right? And so all of the stuff that you're reading about these other kinds of ways of trading, it's kind of like almost not applicable to what we do, right? So the problem that I see is everybody reads Market Wizards and then they try and apply what they learned there to the day trading, and it doesn't work. Now, I've met people that have run, you know, like we talked to Andreas Clay now, right? He's run momentum funds, right? But like it's a different thing, right? A different thing. This magical person that like they're literally day trading futures and they make consistent $1 million. I've never met it. Never met them. Not sure it exists. Went and touched. I tell you what, man. Maybe I should just scrap my entire indicator suite and just make this one indicator $200 and just sell this. Just focus on selling people this because, like, it's just crazy. Some of the trades it comes up with. Well, not trades, but like how reactive it is to that line is just wild to me sometimes. Really seems like the situation that matters is if it's come away from that line in a measurable way and then it comes back to it, it will bounce off of it almost to the tick. The inventory cost basis. There is a case where it did that, but I find that line is not as useful. Yeah, it lined up with VWAP as well. So when I was doing the back testing on them, a lot of the strategies that I was trying and that seemed to work had something to do with if it was above or below, if this line was above or below the VWAP. But ultimately, I think that those were overfit models. So, and part of it was like, I think we need to like, I think part of it was that there's like the difference between tick replay data and live data. Like when I'm just watching the line and I'm doing all this stuff, like it doesn't really matter. But when you're doing something that like makes direct comparisons and everything else like that, you know, the difference of the algorithm getting in 1 bar later or earlier ends up mattering a lot. And so I don't know if the back tests were really telling me anything. That's kind of what the conclusion that I came to was. I think kind of part of the question would be when do you initiate the trade? Because what I basically have here is probably an exit criteria. Like the amount of, you know, available when it bounces, not very good, right? But when do you decide, oh, we're going back up to here? I think that that's the problem with it. That's why I had a hard time getting it to work, is because like it'll like you don't know that it's come back through. You could say if we cross below this line and we're coming back up, but that doesn't work because it could do this, right? So you have to have some level to say the past here, check 1. And then, you know, it came back a certain amount. Like maybe it retraced 50% of this. Maybe we could say if it retraces 50% here, check, then we hold it to the line. Because then for this to fail, it would have to do this and then that, which seems like doesn't happen. I should probably get this here, yeah. I'm kind of trying to decide what are the biggest priorities for me today. So that's weird. Bitcoin had like this insane pump. Look at that. And it's giving it back immediately. It's like, and it's an insane pump. Like the volume on it on the futures is significantly more. I wonder if we missed something. I wonder if there was a headline that I just, you know, because it's in the cryptocurrency world, I was not privy to. Trump plans 10,000 troops on border to restore national security. Bank of Japan balance sheet is an accident waiting to happen. Diamondbacks Trump tariff says good for national security. If it's a little inflationary but is good for national security, so be it. I mean, get over it. Wow, he really said that, huh? I would put it in perspective. If it's a little inflationary but it's good for national security, so be it. I mean, get over it. Is it realistic to start day trading with under $150? No, probably not. Is it bad to learn from YouTubers? Generally, yes, yeah. These are the ones I love to comment about because I can, you know, say crazy things and most people don't know that it's who it is. The downside on this last little move is a little weird. Keep an eye on that. We do have 30 minutes left. Word of advice, Reddit has the worst trading advice on the whole planet, so definitely be more cautious here than on YouTube. Reddit is nothing but trash and garbage. It's so fucking true. And I think that Facebook groups are even worse, but the Reddit is really bad. Those two are the worst ones. I have relatives that are studying at a university, and AI is a plague for all homework, in group or not. Some already 100% rely on AI to answer or write papers. I've read some of their stuff, and it is full of AI hallucinations, but they don't have any experience to see them, not just for code, but architecture and security as well. We will have a big workforce problem really soon. So today I tried to make the room really cold because I've been sweating too much. And it's better, but I still sweat. I'm still sweating. Maybe I should have left the door open. Yeah, well, even on like the broader internet, it seems like it's a really quiet day. My eyes are watering a lot today, too. Do you meditate? Not daily. This is something that I have done from time to time, though. So you kind of have to learn to balance your emotions and hormones and all of these sorts of things that go in patterns, because what will happen is you'll have a propensity to do certain things, like a propensity to take more risks and not realize it and not realize how that's impacting your trading. So, and meditation is a good way to try and like get everything to baseline, I guess you could say. It's also where you like would highly recommend doing some sort of physical activity and not just like, you know, like casual, like you got to be doing something that's like really taxing on you, like really takes you to your limit. PD says, "What if? Well, why are you talking to me like I'm not sure who you are. I wanna." I'm a little worried about myself today because I'm getting through here. I do have a couple of things to do. I was pretty productive yesterday, I felt. And but it's like a quiet day. I'm just not feeling like the chemicals going today. And so I'm afraid that like I'll have a hard time getting started on other work and that I'll just waste the whole day. But maybe me thinking about that will make me that much more likely to actually get something done. I don't know. It's impressive what you do say here, Seth. Generally makes you open to all kinds of negativity and criticism. Yeah, I don't know. There hasn't been a lot of that lately, though. Like honestly, more than anything, it's kind of like we don't get as much attention as we probably deserve. Like, I really think that we have some of the best. I was doing this thing yesterday. Actually, this was kind of a really interesting conversation. So we was talking to my video editor yesterday, and you know, he was like, "Oh, we should make a video like this. Or we should make a video like this." And I was like, "Well, actually, I made a video that was kind of like that. So here's this one. Here's this one. Here's this one." Like part of it was like, I kind of felt like, oh, you know what? I'm actually not following some of my own advice. Because what do I keep saying? Like, oh, the market's not efficient, and sometimes the market is really stupid. So you kind of have to remember that people are boundedly rational, and that might mean that sometimes the straightforward stupid answer is the one that's going to make you the most money. And I wasn't always doing that. I went through this period where, you know, I was really focused on having a good hook for the thumbnail and the title and everything, and making sure that I had content in there that was, you know, presenting it in a way that was unique and you know, basically showing people where the majority of the industry is looking at things and it's kind of wrong. And I was kind of like, but actually, this video might have done better if I had just given a straightforward title. Like, I'm looking at making one that's how much money should you have to start trading? And I think that I should just call it, how much money do you need to start trading? Like, it just should be straightforward in that respect. I wasn't doing that. But by and large, there's lots of really, really good content that hasn't been as widely viewed as it should be. Now, part of that is it will just take time. I understand that we really are like at the forefront of a massive revolution. That our understanding of markets and the economy is changing in a way that it's extremely significant and is just as big of a shift as the advent of Keynesianism. So I think that it's kind of being slept on a little bit. One, because it does contradict some more deeply held ideas about markets that the world doesn't want to give up. Part of it is that it's just like academics, and the academics are so focused on what they were already looking at that they don't really pay attention to it. And the algorithms, they pick up on like words that are already popular. So we're looking for, people are searching for market microstructure or econophysics or any of these other sorts of things. So like that's not a keyword that the algorithms recognize as a topic yet, right? But someday they will, and then they will all come to us. So got to play the long game. Probably I should make a video. That was one of my other thoughts, was we should make a video that's just about that. Because I talk about this stuff on the stream all the time, but like I could make a video about that and say, here are the key people, some of the studies that I would read about it. Because I don't know if somebody that's just casually watching my videos understands that like one of the main things that I'm trying to get across to people is that there is a revolution happening in finance, and it contains a lot of information that can be applicable to your trading. Are we going to come back up to that line again, huh? You know what? I think that my eyes might be watering because I opened up the window. It must have brought in pollens and stuff from outside. Wow, MamSTR has purchased 34% of newly minted Bitcoin since they started buying in 2020. Oh, that's way too much. They're still at 09.5. You know, it also kind of makes me wonder what was kind of the driver at the beginning of the session, because I was kind of expecting it to be quiet, and that initial move really made me think, okay. But then it died just as quickly, so like maybe it was just nothing. I don't have anything that's popped up or anything to make me think that it was, a significant flow. Anything other than just endogenous and market makers messing around. Well, it's the lower end of the range, so let's see what it does here now. Tomorrow everything will be normal. What do we got next week? I'm guessing, you know, if a Thursday is this bad, and there's not any news tomorrow, well, there's a flash manufacturing PMI tomorrow and consumer sentiment and existing home sales. So maybe tomorrow won't be so bad. Yeah, what's next week? Oh, you're right, it is FOMC. And then Friday, Chicago PMI and advanced GDP. That's going to be interesting. Is the Federal Reserve going to come? Oh, dude. So I saw this thing. It was, I forget the name of this. His last name is Clark, but he's an economist on TikTok. And he was pointing out a study that recently done at the St. Louis Fed, trying to, using standard economic models, sort out how much monetary policy, fiscal policy, and supply chain issues led to inflation that we saw. And the thing that was really interesting about it was that it was showing you like how much each component contributed over time. So like what happened was like the supply chain issues were always kind of there, but what really pushed the inflation initially was the fiscal stimulus. And then what happened was that the fiscal stimulus waned very quickly and wasn't a factor. But the Federal Reserve kept interest rates low. And so then it was monetary policy and up until like when we got to the peak of inflation. So I thought that was very, very interesting. So that basically suggests that really the primary, like who should really receive the most of the blame? Well, not most of the blame, but let's just say like who's the worst offender in this situation? Because like Joe Biden and Congress and everything, they did overdo it. And it kind of got things started. But the worst in all of this is the Federal Reserve. And I feel that that's incredibly relevant right now because basically what happened was the Federal Reserve said, no, we need to keep interest rates low. We're concerned about further, more pandemic, and they gave them the benefit of the doubt. They're like, no, we don't actually think inflation is happening, and then it happened, right? Now, all of a sudden, the Federal Reserve is kind of being like preemptively hawkish. So here, I think that we have a case for that the Federal Reserve made a mistake, perhaps because of their own biases, political biases, whether that's conscious, unconscious, or whether it's, they were really trying to screw over somebody, or who knows. But I would say, to be safe, let's just say, like, best, let's just go with the best case scenario, which is that it was just an unconscious bias. Are they now walking right into another unconscious bias by being unnecessarily hawkish? Well, I think we'll see. Last meeting, I was a little bit surprised at how hawkish it was. If they come out and we have another meeting where Powell is really, really hawkish, then I'm really going to be like, I think there's a problem here. I think there's a real problem with the Fed, because I still see an economy and a job market that is just like really, really struggling. And I just don't think that can go on for very long before it leads to a recession. Once everybody has run out their unemployment insurance and there's just too many white collar people out of work, it's gonna result in less economic activity, and it's gonna lead into that death spiral. We're okay if we're like, we leave interest rates or we continue to reduce them slowly. But if he continues to speak hawkishly at every meeting like that, then I think we have a real problem. $9 a dozen for egg. I know I'm still paying like $4.50 for that. I bought some yesterday. DeepSeek's holding company is a quant company. Many years already. Super smart guys with top math background happen to own a lot of GPUs for trading / mining purpose, and DeepSeek is their side project for squeezing those GPUs. Wow, that's very interesting. But I wonder what they were trading. Their mining purposes, they might be more in the crypto world. Well, one of the problems that I see a lot is I see these people that are like, oh yeah, I was a software engineer or whatever, and then I turned over into quant trading and I've been really successful with it. There's at least one guy running around saying that. But then they did it all in crypto, and I'm like, well, okay, that's not necessarily because you're a good quant as much as you just in the risk of crypto. It's coming, guys. Uh-oh, is the MSTR doing stuff? Oh, but that's probably related to this movement that we had with MSTR. Something's going on in the crypto market this morning. Let's go and look at it from that side. It's almost time for me to get going, too, so... Oh, man, this stock is kind of a little bankers. I'm not seeing the little thing that this guy's posted, so I don't know what that's about, but... some somewhat interesting action there. Alright, not bad. DLT not looking so hot though. Especially after last night, huh? I got in somewhere around here-ish. Putin believes key goals of war against Ukraine have already been achieved, so then why are you still there? Maybe that's him signaling that they're willing to negotiate. What's up with Trump wanting to change the Gulf of Mexico? I don't think anybody knows why they want to change the name of the Gulf of Mexico. This person says it has something to do with oil drilling. I haven't heard that before. Well, guys, we had some good content at the beginning of the stream, but it was pretty quiet, right? Pretty quiet today. But it was a good move in the S&P 500 on the upside, and we should get some good activity next week. And the week's not over. We still have tomorrow. But maybe tomorrow I can work on... I probably should have done some programming here while we were sitting here. But that's okay. I have time today. So... guys, I will see you tomorrow. Stay excellent.